Hey everyone, my name's Andy. My channel's Finding Value. If you like making money, if you like commodity type investments, if you like learning about technical analysis, whatever it may be, subscribe to the channel. Give me a thumbs up for this content. And what I'm going to talk about is the boom bust thesis. This is what I've noticed investing over the years, where if we can identify market conditions, that's market conditions and valuations, you can absolutely kill it as an investor. And if this is the value of knowing when to be in what sectors. And this is what I'm going to go over. And again, this is my opinion. It is my approach. It's okay if you disagree with some of this, because this is my approach to investing, and this is what I found over the years of investing. You get this right, the returns will come. You have to be patient, and this is for a cycle. We're trying to identify cycles, and these cycles, it's very hard to knock them out of cycle. You can have crashes in these cycles and they'll continue to go up. You can have dislocations like COVID. It doesn't really necessarily disrupt the cycle, but there could be, if something is large enough, it could maybe delay it. That's kind of my viewpoint. Remember, this is my viewpoint. Financial education and not advice. So we're going in here. This is the boom bust thesis. This is how you make money, guys. So this is the real estate. Real estate's the driver. This is my opinion. This is my thesis here. Real estate is the driver of inflation and deflation. You can tie that to demographics. We can get signals before the crash happens through real estate. And what I look for, those leading indicators, are house prices, inventory, days on the market. I also use housing starts, and that's where really the inflation comes from, is when you go into an expansion phase where you get new loans on new homes, which is very inflationary. It expands the money supply. And right now, I think the current situation that we are in is in an expansion phase of real estate. I'm going to go through that and show you where you should be, what the real estate cycle looks like in later slides. And the last crash and how we could see it before it happened, I'm going to go over that as well. So the boom bust cycles here. What a boom cycle is, it's basically, it's nothing more than just leveraging up. It's inflation and credit expansion. That's literally the definition, is an expansion of credit or inflation. On the backside is a deleveraging. It's a deflation. It's a credit contraction. Credit defaults and credit gets destroyed. The system is inherently deflationary when certain limits are hit in terms of debt to growth. And we could be there. We could. The system cannot survive with deflation, though, because what happens is it all collapses. So what I see in history, and when you look at currencies, is that history proves that the money creators default through inflation and not deflation. Government revenues need inflation to work, and what happens is if you don't have inflation, they default in deflation and everything goes bust. So in order to have this currency system survive, they have to inflate, period. You can have short-term deflation kind of bouts, but you have to inflate in order for the system to survive. This is the real estate cycle. So we have a recovery phase, expansion phase, hypersupply phase, and recession phase. The red line is the leveraging up of the system, and this is where it really starts leveraging up, is in the expansion phase. Then we've got a deleveraging down, which is the hypersupply to recession phase. So this slows down. You don't build as many homes. It starts to collapse. Inventory gets larger and larger. Days in the market go up. And everything starts to slow down. And basically your expansion goes into a contraction, which is the recession phase. And in my opinion, if you're in a recovery phase, a recovery phase is really low inflation. It's not super large inflation here. So I think stock and technology is pretty good because you're going to have low interest rates from the recession coming down. They usually lower the interest rates, and stocks and technology do absolutely well in this recovery phase. And that's what we're entering. We're exiting a recovery phase and entering an expansion phase. That's my opinion right now. And in an expansion phase, what you're going to see is higher interest rates. You're going to see more inflation. And this is where commodities and precious metals really start to shine. Obviously, you can be in real estate as well in this expansion phase because real estate prices are going up. Eventually, they build too many homes, and you have a hypersupply phase where things start to contract because they built too many homes. This phase, it favors bonds and dollars because this is where everything starts to contract and deflate down. This is where you go from high interest rates to lower interest rates. And what prices bonds and dollars higher is the lowering of the interest rate. So that's where you want to be positioned at the top of a real estate hypersupply phase. This is the median sales price of houses sold for the United States. I've got circled the last crash, but you can see these like crash sideways movements throughout history where they kind of pause, goes up, pause, or comes back. We went up, it paused a little bit here, and now we're into an expansion phase. You're going to see prices go up. And I'm going to touch on housing starts, because housing starts, you can see the real estate cycle through it pretty easily. So this is a recession, recovery phase. This is an expansion phase. This is the one. So the 1.5 million I have, this is the red line here. This is what the yearly demand is of new homes. This here is housing starts or new privately owned housing unit starts. So this is just new homes being built. The red line's the yearly demand. So when you're above the red line and you're going up, you're in an expansion phase. You're in a hypersupply phase here. It comes back down into a recession, and then you go into a recovery phase, and then an expansion phase, and this cycles back and forth. And what I'm telling you is the real estate cycle. The cycles back and forth about this 1.5 million demand line. Now, there's some problems here on the right-hand side, and I'm going to go over what those problems are. Whenever you go below this 1.5 million line or above it means you're overproducing and you're working off maybe this deficit here. So we have a deficit here. We had to go into an expansion phase. It went sideways for a little bit, and then we went into an expansion phase, and we overproduced. There's more area under the curve here than there is in this area in here. What happened is we went into a hypersupply phase. We had a bunch of mortgage defaults, and we screwed up the housing starts for many years. We undersupplied new homes for a very long period of time. So what we have is a large area under the curve here, which is very, we'll call it, we need to build a lot more homes. We have a large deficit of new home builds. We had a lot of families created that are looking to buy homes, but we don't have the homes to physically purchase for all these new families. So we're going to have to go into an expansion phase, roughly the same size as this deficit here. And another thing I want to show you is these dark lines are recessions. That's what these darker areas are in this chart. And whenever we go into an expansion phase, we've never been in a recession in an expansion phase outside of this dot-com bubble. The dot-com bubble, I think, was pricked by higher interest rates from housing. And I think that it's happening right now to the technology stocks again. I think the technology stocks are going to have a bubble, and it's going to get pricked by higher interest rates or higher yields. And I think that's happening right now as it's peaking and going to head back down. So if you can identify the cycles of real estate, you can identify where to be. And so I think that we are in this expansion phase, and the expansion phase, if this is the 1.5 million line right here, this is going to be the expansion phase. We want to be in, it's going to be inflationary, and we want to be in commodities and precious metals. And we can see that we're entering an expansion phase above that line right now. This was an expansion phase of the last cycle that peaked out in 2007, 2008. This one's going into an expansion phase. Now, if we're going to see an expansion phase, we can look at the permits to get a better idea of what the housing starts might do before they actually even go up. This is the new private housing units authorized by building permits, and you can see this thing's going vertical, which I think means it's going to be inflationary. It's going to be inflationary, or they're scared that the moratoria is going to end and they're trying to get permits in. But I think we're in a expansion phase of real estate. Keep in mind, this is a recovery phase, and it's been building steam and momentum the entire time. COVID shut everything down so that we see this little blip here, but it shot right back up, and we're continuing to build strength to the upside. So I think we're going to continue to move to the upside until we see the leading indicators change through inventory, days on the market, and home prices. But right now, I'm going to show you what those look like. So this is the average days on the market, and we can see this is declining over time, even in 2018, 2019. This is holding very steady at 12.5 months. Sorry, this is days on the right-hand side for blue. So days is about 100 days on the market, and we're declining, and we've had a fallout. We also see our inventory. Our inventory was declining over 2019. It came up for the COVID problem stuff, and then it shot way back down, and we're at 1.9, which is an all-time low. So our inventory's been eating up. And if you look at the general trend here, it is going down, this general trend. And I'm going to show you another trend here, a bigger picture view. This is looking back at the crash. This is kind of an aggressive, we need to build a lot of homes. Low months of inventory is like 4. 4 is pretty low. And then you can see that we had a problem here. It was shooting up. We went from 5 to 6 to 7. It's like, we've got problems. That was in 2006. So we knew we had problems in 06, 07. 08 is when everything blew out. But you can tell we've had 2 years before that to see this housing metrics and inventory really shoot up. And it peaked at around 11, maybe 12 here. This is a great time to be buying a house because this is where prices are going to be the lowest. Then you can see a recovery phase in 2010 onward as the inventory got drawn down and drawn down and drawn down. And you can tell that they're going to draw this inventory down because the housing starts were so low. They weren't building any new homes. So we were just sucking up the inventory that was out there, and that's exactly what happened. So we sucked the inventory up, and now we're at this super low area. And today we're even below 2. We're at 1.9. We're way down here. We have a problem. We're not building enough homes. That's what I'm seeing. We need to see this, the months of inventory for homes. We have to see this reverse and come back up for us to see a market crash. Now, is there a risk of the moratoria ending and a bunch of homes coming on the market? Potentially. I don't know how many homes are going to come on the market. I don't think anyone else does. But we have to see this data change and move the inventory upward. Right now, we're at 1.9, which I showed you, which is off this chart down to the low side here, which is absolutely ridiculous. We're going to see home prices go through the roof because there's no homes to buy. Too many buyers. The seller's market. The greatest seller's market probably that we've ever seen in history at this time. Demographics and real estate. So demographics is the ultimate driver for real estate demand. That's my opinion. Real estate demand drives up home prices and then kicks on the housing starts. That's what kicks this all and starts it all up. Housing starts is where new loans come into the system, driving a leveraging up of credit and inflation. The real estate lending gets money into the hands of those that can spend and kicks up velocity as well. And keep in mind that the people who are buying homes are in home buying years, and they are spending the most amount of money that they're going to make when they have kids, when they're buying homes, they're buying furniture, they're buying all these things. And I think the peak spending's in the mid 40s to late 40s, somewhere in there, all the way up to maybe like 50 something. So like early 40s to 50 something, they really start to spend on their kids. And when their kids move out, their spending really drops. So we're coming up into the millennials in the home buying years with kids and whatnot, and they're going to be spending, which typically gets you a little bit of velocity increase. And remember, these people are also going to be inheriting a lot of money from baby boomers when the baby boomers pass away. Unfortunately, that's what humans do. So this is how I view things. Hopefully, you got to have a better understanding of the real estate market and how it impacts investments overall. I think that demographics and real estate are the driver of the rotation of money and spurs that rotation of money because interest rates are spurred through inflationary cycles. Looking at history, we've only had recessions when housing starts and real estate goes down. That's the deleveraging portion. The leveraging up is on the recovery and expansion phase of real estate. If you can get this right, and you can do the ratio analysis to get the valuations, this is where you can crush it. If you get it wrong, I don't think you can make money. I think you have to get this right. And if you want to validate this thesis, if you want to validate your investments, look and see what the successful investors are doing, the billionaires. Look what Warren Buffett's doing. He's buying a bunch of oil companies. It's like, well, why is he buying oil companies? Why is he buying all these commodities? Why are the billionaire investors getting in on the commodity trades? Why are they buying precious metals, et cetera, et cetera? So if you want to validate your thesis, if you want to validate or my thesis, whatever, look at what the billionaires are doing. Get more data out there of what people who are seasoned investors and see what they're doing, just to validate your thesis. So hopefully you guys like this content. Give me a thumbs up. Subscribe to the channel if you haven't subscribed yet and you like these types of presentations. Leave comments below on anything, or if you disagree with it, let me hear it in the comment section. Love to hear your opinion. And thank you for listening. This is Finding Value.